Well, welcome to the next video in the Crypto Trading Mastery Training. In this video, we'll cover creating your own stop loss strategy. This is something that's really important in the crypto market. I know that there's really the ability sometimes to actually not trade with stop losses and sometimes just wait it out, and eventually things do move back up. I think that's a bad habit to get into. Number one, it's a tremendous waste of your capital because you're just sitting on that. The other thing is that the second that the market matures to the point that that's not going to happen, you're going to be facing a lot of losses, okay? So I believe that if you're not trading with stop losses now, you should get to the point that you're trading with stop losses. And that's what we'll cover in this video. We'll cover the number one question you need to ask to set stop losses. We'll cover the two types of stop losses there are, and we'll talk about whether or not you should use a trailing stop or a hard stop and what those are. And we'll just dive in. I'll share some examples as well. So the first thing is that when you're setting a stop loss, the size of your stop loss, and if you don't know what a stop loss is, I'll just cover this. But a stop loss basically is if we enter a trade here on XVG, and we're looking at the weekly chart on XVG, and the trade goes against you 11%, you are out of that trade at a loss, okay? Thus the name stop loss. Now, so that's a stop loss. There's two types of stop losses. The way to look at it, there is what I call the discipline stop loss, and then there is the system stop loss. The system stop loss we'll start with is using a system like 3Com, where when you enter your trade or you buy, you will then go into the system and you'll set a stop loss. And it'll either be a trailing stop loss, which we'll cover here, or it will be a hard stop loss. And I'll cover in this video reasons to use either one of those. The other stop loss is called a discipline stop loss. Now this is a stop loss that you're not using a system, but you as a trader have the discipline that when it hits this 11%, if that's where you said your stop loss is, that you will get out of that trade. And what you will not do, okay? And this is if you use a system as well, because obviously you can go in there and update the system. But what you will not do, unless there is things within the market that is telling you otherwise, but more times than not, your initial assessment was right. You really have to get to the point where you trust yourself as a trader. No one else. You need to trust yourself as a trader. You're the one that is the most responsible and that cares the most about your capital and your success. No one else cares as much as you do. So you have to look at it from that perspective. And so unless something else in the market changes, you need to have, if you use this style, you need to have the discipline to get out of the trade the second that it doesn't look right or it goes against you. The other thing is you can always enter again. You can get out. So if we look at this trade, and let's say we were in this trade and it went against us here, I could get out right here and I could get right back in. There's nothing saying I can't get right back in. Now, obviously I sold at a loss, but what is better than sitting on the trade here and being down 11% or being down 30%? That's where you'd be currently down. And you'd be down even more than that longer. So you would have been down 37% over the course of about 3 weeks, maybe 2.5 weeks. What's the point of that? Is that a good use of your capital? Now, obviously, your stop loss and how big it is and where it's at is dictated by the trade you're doing and your trading style. If you are trading off the weekly, like I am here, we're looking at Verge, XVG, on the weekly, and you're looking to hold this for a long term and you believe in the long-term potential, well, you would look at maybe the potential drawdown and you would say, well, there's a 62% drawdown right here, and then from here, from the close and the open, there's a 50% drawdown. Well, you wouldn't know that here entering the trade, but then you would say, well, here there is a 60% drawdown. So if you're looking at that and you're entering the trade here, but you're looking for a potential upside 6 months, you know, maybe longer, and you're saying, well, I believe that there's an upside of 250 to 300% on my capital. If you believe that, then a 40%, a 50%, a 60% stop loss might be called for. That's a lot of a draw. That's a big drawdown, obviously 60%. I think the other strategy that serves better in crypto is, and we'll cover this in this video, is putting tighter stop losses, then rethinking as the market moves against you, as BTC moves, and then maybe scaling in on the upside. So you're scaling in here, you're scaling in here, or scaling in on the downside. So you enter a little bit here, you're not quite right, and then maybe you get stopped out, so you enter a little bit here, and you get stopped out again. Designing this really will dictate on how you want to use your capital. That's the important thing. The type of trader you are, the type of trades you do. So obviously, if you're doing longer term trades, you need to give it more volatility to move. When I say volatility, well, it moves this. If we look at the charts down here, it moves anywhere from, it's pretty big movements. That's the problem here. It moves anywhere from 40% on the upside to, and I'm looking at this chart here. So 40% on the upside to 30% on the downside. So it moves, it has those big swings like this. When you look at that, you'd have to factor that in for setting your stop loss on a longer term trade. The first thing you have to look at is that what type of trade are you doing? Is it more long term? What's the average range? What's the average movement? So the first thing that dictates your stop loss is actually the type of trade you're doing. But even before that, here's the number one question you need to answer on any trade that you're doing. Okay, it doesn't matter if it's a longer term trade, a swing trade, even if it's a quick scalp. The number one question is, at what point will I be wrong about this particular trade? That should be the way that you set your stop loss. So when you look at a trade, let me pull up another trade, and we're going to go to a lower time frame because this will illustrate this better. So I'm going to pull up EOS BTC, and I'm going to talk about a current trade that I'm in, and we'll go to the hourly. And I know we'll just remove all this stuff. So there's value channels here. You can see the value channels, moving averages, and there is one point in time here on these days here, or these, not days, but these hours here, where volume just dropped off. And I looked at that as supply drying up on these 2 hours here. And what was the other thing that was really interesting that happened there? It was above a moving average. So I had a couple things, plus it was at the top of a value channel. So it crossed moving averages. It was kind of in the middle of this bottom value channel. So to me, that looked like, okay, this looks like a good setup. So I entered the trade here with a 5% stop loss because I asked the question. I said, at what point in time, if I enter this trade here, will I be wrong about this trade? At what point in time? So I was looking, I wasn't using the bottom of this actual value channel. What I was using more is this support, this whole support line here. And I was looking at it from this perspective. I was saying, well, if I enter the trade here, it's above moving averages. If it doesn't bounce off the moving averages, so let me pull up my arrow here. If it doesn't bounce off these moving averages, so it was already there. I was buying right at these moving averages. I said, if it doesn't bounce off all these moving averages because it's above them, if it doesn't bounce off these, then obviously those aren't holding up for any type of support. And then if it crosses all this consolidation range here, all of this consolidation, all of this, then obviously that wasn't real consolidation, and obviously there's something fundamentally wrong with the trade, and I want to be out of this trade because who knows where it's going to go. So I put my stop loss at 5%. Here's another way to look at this too, okay? And then we'll get in with this one trade, we'll get into the different aspects of doing a stop loss. So there's two types of stop losses you have to consider. So the first question, I'm going to repeat it again. You should always be asking yourself, at what point will I be wrong about this trade? At what point in this trade, will the market movement, the price, show that I was wrong about this trade? Because my expectation here was that it was going to rise, and looked at was this upper channel, right? I looked at this upper channel and I knew there'd be some resistance here, which there was. And then, and if we go back in the chart, this upper channel was drawn from all the way back here. So that's where that upper channel was. So I knew there'd be some resistance there, but then I figured that it'd stop right where it has stopped, at the top of this channel. That's where I figured it would stop. This is a 20% upside at a minimum if I do take profit there and reassess as it gets up here. That was my thinking in the trade as far as profit potential, but a 5% stop loss is well within the risk reward for a 20% move, well within it. And I'm still in the trade, actually. So still in the trade, and I actually added as it broke this value channel. So as it broke this second value channel and continued up, I actually added to it. The question I answered, though, is that at what point was I wrong? Because I don't know. Entered this trade, well, that I explained it crossed moving averages. It went below support. At that point, I want to be out because it might bounce, but it crossed two things that it should have held up on support on. So obviously I misread. And I can enter again. There's nothing saying that I can't enter again. And I often do that. Sometimes it will retrace back a lot farther than I anticipated, and then I will re-enter with the same kind of profit potential. But obviously things have changed in the market since then. So that's the first question. Now the next question you need to answer is, do I use what's called a trailing stop, or do I use a hard stop? Now this is kind of a simple way to look at it, and I think it's the way to look at it actually, which is, well, if I say right now, if I start off this trade and I say that I'm looking for a 20% minimum profit here, hoping for more, but at this point I know I have been wrong about this trade, should I use a trailing stop? Now a trailing stop, what that does is that as the price rises, the stop, it will rise with it. So the trailing stop will be here. As price goes up, the trailing stop will continue to be here, and then it'll rise here, and then it'll rise up to here, and then here you would have been out of this trade. So if you did a 5% trailing stop, right around 5%, you would have been out of this trade here on this retracement. And that would have been from, let's say, this point here. That would have been an 8% move. You would have made 8% on that. The difference, though, what I did is I didn't do a trailing stop. What I did is I did a hard stop, meaning that the stop did not move. It stayed here. So I entered here. I entered right around here. And the stop was here. And I kept the stop there because I said, look, I'm going to give it plenty of room to do whatever it wants to do in this range, right? Whatever, I didn't expect it to do what it did here. I didn't have a clue. I figured it was going to just go a little bit, kind of move slowly. I didn't realize it was going to move like it did here. I didn't realize it was going to make a 12% move and then another move. But I knew at this point in time, as far as risk reward, this is where I want to be out of this trade because at this point in time, this trade is not going in my favor. And once again, if you use a disciplined stop, meaning not a system, if it gets to this point, you have to have the discipline. And I do this, but I had to work myself up to this point. But you have to use the discipline to get out of that trade. Okay? Otherwise, use the system and you don't have to think about it, right? It never even got close. So when I bought, from that point on, it started just going up. A lot of times you'll notice that in some of your best trades, it depends on your trading style, but some of my best trades, it doesn't even get close to my stop. It just moves from there, right? Especially if you enter in something like this where it does look like supply's dried up, right? And then BTC also moves as well. So you'll see here BTC moved, and that just gave it a catalyst for it to continue to move. The next question is, do you use a trailing stop or do you use a hard stop? I tend to use hard stops a lot just because when I look at it, I say, well, that's the point that I want to be out of this trade. So I'm willing to give it room. But there are times when you might want to use a trailing stop. And a trailing stop is when you're looking at something and you do want to protect some of your profit. meaning that as it rises, it's not maybe this volatile, but as it's rising, your trailing stop is rising with it. And so I'll give you an example of this. So a better example of this is actually a trade I did on AE where I entered down here and I did a trailing stop and it just moved, and I continued to be in this trade. I was still in this trade here, still in this trade here. It moved up here and I didn't move the trailing stop. And then I actually got an exit here on this retracement here. So when you're doing a trailing stop, the downside there is that it depends on how tight you have your trailing stop. But the downside there is typically you're not maximizing profit, which it's tough to do anyways. But you're giving the trade plenty of room here to actually work. I gave it plenty of room here to work out, and it retraced back. And maybe I should have gave it a little bit more room because it looks like it has found support. But I was happy to be out of this trade right around 11-10%. That's a good swing trade. I was happy to be out of it. It wasn't a long-term position. I was actually out of it much quicker than I anticipated. And if I would have been watching it, I didn't set a profit. I literally just had an exit on a trailing stop. So I just said, look, I'm just going to see where this goes and then exit on a -5% trailing stop. Choosing that and using that really will depend on how you like to trade. Will depend on the type of trades that you're doing and the type of trading that you actually employ in your own style. I can give you general guidelines, right? We can cover this and I can go over this, but I can't answer which one's right for you. Because what did I do on EOS here as we go back here? Well, on EOS, remember I started with a 5% hard stop and it moved and it continued to move, and my stop is still down here. My stop is still down here. I didn't protect any profits as it was moving up, okay? But as it approached this and got rejected, I anticipated that it was going to I thought it was going to retrace back here at least half. That was my anticipation. It was going to retrace half of this move. I thought it was going to retrace back to here, but it didn't. So I kept my stop in place just because I was going to let it just move around within this range and then break this next channel. That was my expectation. It didn't do that. It did, I guess it did have rejection down here. So it did get rejected down here, but not quite all the way to the bottom of this value channel. And then it continued to move. The second that it broke, not the second, but when it broke this value channel and then it started closing above this upper channel here, I moved my stop up. I moved my stop because what did I asked the question. I said, okay, I'm in this trade and I want to actually protect some of my profit. And I moved my stop up here right at this moving average right here. And back then, this moving average was down here. So keep in mind, I moved it up to the moving average, just below the moving average. The problem is I moved it up back here, okay? And I moved it up today. So I moved it up where this moving average was. And then today, what did I do? As this moving average moved up, I moved it up a little bit more. So I moved it up here just to protect a little bit more profit. Just because as I was looking at what was unfolding here, and with Bitcoin, we're going into a Monday. The Asian morning is happening actually now as we speak, and I just wasn't sure. So I moved my stop loss here, just enough room to give this moving average here, which is the 50. I wanted to give it enough room to reject off that because it looked like it was trading over the 50. I gave it enough room, still protected profit. Right at that point in time, I was up. I would have been up 12%. It's nowhere near the 22% that was here, but I'm giving it plenty of room. I'm giving it enough room because I looked at the chart from this perspective. That's the other important thing if you're going to move your stop loss, is that now I'm protecting my profit that I have in the trade, but I want to reap. I want to be patient with the trade, okay? One of the biggest mistakes that people make is that they take too much losses, they put their stop losses too big, and then when they make profits, when they're in a profitable trade like this, they'll exit right now, or they would have exited right here the second that I had a retracement. They would have got out of this trade right here at just 12%. I did look at that, but I also looked at the fundamentals of where things were at. And I looked at it from the perspective, if I entered this trade here what would show me that this trade was not going my way? That's where I'm using value channels here, right? I'm using a couple of different things. I'm looking at volume, price action, everything else. I'm keeping in mind what BTC is doing. And we see here, don't we? This is BTC. BTC is starting to just slowly tick up. So that's 7,700. It's been playing in this range for a while. As I look at this, I was expecting a retest of the bottom of this channel. If it was on its way down to retest the bottom of this channel and it broke this support here and this support here and it broke the moving average, then I want to be out of that trade because it's probably going to most likely test the bottom of this channel. So why don't I just get out with profit? I've gave it plenty of room to figure out whether or not it wants to go up, but I want to be out, protect some of my profits, and not risk that it's going to retrace back even further. So because most likely, if it's going to hit here and it's broke all this support, it's going to retest the bottom. It's going to retrace back to half this, most likely. Now, the other way to look at this too is obviously if I'm in this trade longer term and I do want to give it more room, here's another way to look at it, and this works very well as well. I don't know if that's the right way to say that, very well as well, but we'll stick with it. So let's say you entered this trade here, 5% stop loss, and you don't move your stop loss. It's a hard stop loss. And you just say, I'm in this trade, and that's where I know this trade has gone against me. So you give it plenty of room. You're up now. You're plenty patient. You're not locking in any profits. You don't have any trailing stop. None of that stuff. And basically, you're giving it plenty of room because you're in a good trade. And you feel like there's a bull side to the market. You're not doing swing trades. You're doing longer swing trades. And maybe that's the way you trade. So this could work as well. You could do this type of trade. I still think I hesitate to mention this just because it's if you watch a 20% profit go all the way down and then turn against you 5%, that's a big move. But there is something to be said about trading that way. There is something to be said, especially if you are checking with your trades. You should just never just put on a trade and kind of set and forget. I wish it was that way, but in crypto, it's very volatile. So you should at least check on your trades. And if you look at this and you say, well, look, it still want to give it room to maybe come back here and retrace half, because I'll give it room to retrace half. Let's just say this is you can only trade once a week. And so you're doing longer term swings and you're entering positions on a longer term basis. You're probably not trading off the hourly, obviously. So if we do look at the 4 hour or something, you're probably not even trading off the 4 hour, but let's say you are. You're looking at this and you're saying, okay, well, it will probably retest this. So as you're looking at this, you're saying, well, if I enter here and it does go in my favor, then it's going to bounce off here. That would be your first assessment based on value channels. And then from there, it's going to maybe then play between this channel, but it's going to find support here. That's what I'm looking for. Or ideally, you would be looking at this support line here, resistance, support, and say that this is going to hold up as well. So you have a couple different things. Plus you have moving averages in there, right? You have all these moving averages. So you have moving averages here and everything else, but you're still in this trade. You can look at it from that perspective because there you're giving it plenty of room, right? Because you're on a longer term time frame, because then you're expecting a bounce from here and then this type of wave. You're expecting that type of wave. A wave up, retracement, a wave back up. And maybe even a wave up to here, right? If it's a slow mover. And then ideally you'd like to see something like this. That would be strength. And then here. And then maybe your plan is, and this is why you should have a plan going forward, is at what point do I move up my stop loss? Well, maybe at this point you would have moved up your stop loss. You would have said, well, now it's got a new support base, right, within this channel, and it's previously used this support base as well, in this value channel. So as it goes up across here, if it does cross this support base, then obviously the trade is broken down. So then that's maybe where you would move up your stop loss, give it plenty of room to get rejected here, everything else, and then say, well, at that point in time, I want to be out of this trade. It's just the only reason, if you have a longer term perspective, I think that's good. I think the other thing you're going to do during that time, ideally, is that you're going to add to your trade. Is that as things move, you'll add to your trade. Maybe when it got in this channel here and then it breaks out, you would add to your trade here, because you have a winning trade, so you're going to trade the breakout. So you're adding to the trade with the same type of 5% stop loss. And then you've got profit already, and maybe you did move up your stop loss, but typically that's what you're doing. Typically you're doing something like that. So each one of your trades has its own little stop loss. You are looking at the overall position, but each trade has its own stop loss. And I anticipate we might see some movement here because Bitcoin seems like it wants to go up and test. It might get rejected too, but it seems like it's starting to move up. So definitely interesting move there. The key here is it's really simple. The number one thing you should always keep in mind and you should always ask is at what point does this trade go against me? At what point am I proven wrong? There's nothing wrong with being wrong. In trading, you've got to get used to being wrong. You're not going to be right all the time. There's some traders that have developed a system and they trade very infrequently. But when they trade, they're usually right away. If not, they're out of that trade. That could be another style of trading. So I know there's some successful traders that what they do is they don't do a lot of trading. But when they enter a trade, they're usually right away. And they continue to be right, because the second, if they're not right away, they're out of that trade instantly. And it's pretty quick because they're in the trade and it didn't quite go their way, and then they're down 1 or 2% and they're out. So that could be another style of trading. It once again, it comes down to, can you develop that within yourself, right? Is that the type of trader you are? Is that the type of trader you want to be, right? So, but the first rule in stop losses is, at what point in time does this trade go against me? Okay. Now, when we talk about risk and reward, and we talk about, well, how much should you risk? Is it a 2-to-1? Is it a 3-to-1 ratio? I think that this is one of those questions that it's different for every individual person. It's different for the different type of styles that you're doing. At a minimum, I think it should be a 1-to-1 ratio, meaning that if you have an 8% stop loss and you're looking to make 8%, then at a minimum, that's what it should be. But here's the challenge with that. You need to do the math. It really comes down to a math. It's a complete math problem. If you're only making 8% on your winning trades and your downside is 8%, the math does not work. Your math should be more like this: 4%, 18%. For all your losers should be right around a low number, right? The lowest number possible for that trade not to go against you. And your winners should exceed your losing trades. That's the way to make the math work in your favor. So if you don't have a system that is developed for that, you need to develop your system of trading entries and exits for that. Okay? And one surefire way to fix that, and this goes along with stop losses, and I've mentioned this in other videos, is that one way to do this, and if we go here, is let's say that you would enter this trade here. Okay? You'd say it looks like it's going to break the channel here, this sub channel, and you do a 5% stop loss. The easiest way to do some of this is, instead of entering right here where you think it might be, is entered where your stop loss would be, down here. Now you still would have got stopped out here, right? Here, you still would have got stopped out here, but you at least gave it a chance, or you at least entered at a better location. See, a lot of people just aren't patient enough to be able to do that. That's the challenge. Okay, they see what is the one thing. If you're getting continuously stopped out of trades, this is the number one. It's a number one indicator that you're entering too early. Something in your system is telling you to enter too early. You're most likely not being patient enough. So the one way to fix that is to then look at your system of entries and look at how you're entering trades and be patient. And that means you're going to miss some trades. Yes, you're going to miss some trades. But if you just enter, if you choose a 5% stop loss, right? And I believe 5% is a good stop loss number for most trades. I've back tested this, and I can say that most, if we go back here and we're in the 4 hour, anywhere that you enter, and except for, yeah, anywhere that you enter, you'll see here that if it retraces back 5%, you're out of that trade well before any bad retracement. 5%. 5%. And I know it's moving because it's moving with the numbers, but you'll see 5%. You entered here. Obviously, if you entered here, 5%. You enter. So you're being protected, meaning that it goes down a lot more. Here, if you'd enter here, you probably weren't, you might have been stopped out right here, but you had a little bit of time to make profit. So you had a little bit of profit potential. So maybe you moved it up to protect some of your profits, right? A lot of this is dependent on BTC. See what BTC did here? BTC just tanked there. So, but here, you enter here. The bottom line is I've back tested a lot of different charts, a lot of my trades, and I used to divvy up the stop losses between 5 to 15%, okay? And I'd get exits at 15%, or I'd do a trailing stop at 15%. This is what was happening. A lot of these I do a trailing stop at 15%. So I might enter here at 15%, okay? And I wouldn't take a profit at like 13 or 15%. Usually I probably would, but let's just use this as an example. So I'd enter at 15%, and then it would go up, and then never get into profit, and then I would get exit at 11%, negative 11% or something like that, right? That would be kind of how it would work out. And then I started moving up my stops. Then I back tested everything thoroughly, and I found that if I'm wrong on an entry, then something like BTC has tanked or something has happened, and I'm wrong. That's fine. I'm wrong. Okay. Well, I want to know that I'm wrong as quick as possible, but I want to still give it plenty of room to kind of like maybe be a little bit wrong. Okay. And 5% is that little bit wrong. That works very well. And a lot of times though, I'll get out before 5%, meaning that if I wouldn't have entered here, but let's just say I entered here. Okay. And then it immediately went against, and it was only at 2%. Right? I might look at it and say, you know what? Obviously, I misread it. Something's wrong. And then I'd get out. Sometimes it turns against me. Or not turns against me. It goes right around. So let's say I got out here and then it started turning. I might re-enter then. Re-enter then with 5%. You can always re-enter. There's nothing saying you can't re-enter. The number one thing for you to do is protect your capital. Okay? That's the number one thing for you to do is protect your capital. Here's what you need to do next, okay? You need to look at your entry system of how you enter trades. And you need to define how you enter a trade, and then define at what point, what signals do you use to tell you that that trade is no longer going in your favor. And I would suggest, and I don't even know your trading style, what type of trade you do, but I think 5% is a good rule in this market. I think if you start with 5%, you're going to become a better trader, and you might open it up. There's some trades because you look at the chart and you just say, well, if I do enter here, I need 6 or 7% to be below support. Okay. The other thing that I did not mention that I wanted to mention sooner is that this is an advanced strategy, but you should ask, where does the market want me to have my stop loss? This market isn't quite to the level where there is some stop hunting, okay? Where basically there's orders just to hit stop losses and to spike price and to do a lot of different things, okay? There's some of that, but it's not sophisticated enough yet. But what you have to start getting in the mindset of is that where's the most logical place to put a stop loss? Okay? And is the majority of people going to put stop losses there? So if you find that the 5% range, like if we use the 5% range, is where the majority of traders would put their stop loss, then most likely you're going to get stopped out. It's another way to look at it, okay? Why are you going to get stopped out? Because as the market gets more sophisticated, as stop hunting starts becoming more common, and sometimes that's just where things retrace back to. Just that's where a lot of sophisticated money looks to enter, is well below that support area. So if you enter here, right, if you enter here and you say, well, this is a good example. Let me turn off the SMA gain so we can see it very clearly. If you enter here and say, well, I'm going to put my stop loss just below, let me scroll in, just below this rejection point here, just below that. That's such an obvious stop loss right there. That's where the market, the way I look at it is that's where the market wants you to put it, okay? And you should not do what the market wants you to do. So I try not to do what the market wants me to do. I don't try to interpret the market, but I also do think about, okay, well, where's the most obvious place to put this thing? Well, that's the most obvious place. You know what's not so obvious? Down here. But that's beyond my rule. That's 8%. So what does that mean? I don't take this trade unless I have a really good reason to take this trade. And then if I did take this trade, let's say I did trade this breakout here, what would I do? I wouldn't do a 5% stop. I'd do a 1% stop. So let's say I did enter in this bar. I'd say, you know what? I'm going to enter this and it's going to go in my favor or it's not. And if it doesn't, I don't want to, if it's a 1.5, let's say, 1.5%. So I'd enter this trade as a breakout on this 4-hour time frame here and say, look, I have reason to believe on various volume, other things, whatever, right, that this is going to move up and I'm not going to give it room. If it doesn't work in my favor, I'm out of this trade. So I do trades like this. So I do 1% stop losses. But usually in something like this, I'm watching it and I will stop out the second that it goes against me. So if I'm doing something like this, I'm typically not going to go in with a lot of size. So that's the other thing, is that because I'm not doing these type of trades and going in with a lot of size unless I just have very big confidence that this is going to be a move that I want to be in. Okay. So, but that's another way to look at it, because what did I answer? I said, well, I enter here on this breakout, and at what point will I be proven wrong that this isn't a breakout? Well, the second that it breaks this support here. The second that it breaks this support, there wasn't an exuberance of excitement for an upside. So I want to be out of this trade. That is a way to trade, actually, is just define your stop loss depending on that. But I also looked at it from the perspective of it doesn't make sense for 5%, because at 5% entering here, this is where the market wants me to have the stop loss. Okay? That's where the market wants me to have it. That's where majority of people are going to put their stop loss. On the 4-hour, right? That's where people are going to put their stop loss, down here. Of course, you should be looking at the hour and everything else. But that's where the majority of people are going to put their stop loss, well below the support and the rejection. Because they're going to say that if it gets below this, then I want to be out of this trade. Well, more times than not, it gets below that. Okay? So if I entered the trade here, I just want to be out sooner. I just want to be out here, because the trade setup doesn't make sense for 5%. But here, this trade setup makes for 5%, doing a trade here at 5%. Why? Well, because some people are going to put a stop loss here. They're going to look at the most recent support. And then some people, most aren't going to do a value channel, but you know that a value channel, the middle is strong. So some people might put it here at the middle of the value channel. And then 5% is down here at the middle of the bottom, almost the middle of the bottom of this value channel. I'm giving it plenty of room to get rejected on this bottom of this channel, this support here, right? I'm giving it plenty of room to get rejected and to find support at this support area here. And I'm also giving it plenty of room for the middle of a value channel. So it fits my minimum trade criteria. That's the way to look at it, is that's why the 5% works there. Why doesn't it work here? Well, you ask that question, where does the market want me to put my stop loss? Where is everybody else going to put their stop loss? That's probably a more friendly question. Where is everybody else going to most likely put their stop loss? Well, they're going to most likely put it here because they're scared of losing, so they're going to put it as tight as possible. And I know that sounds contrary, that they're scared of losing. You're going to say, well, weren't you scared of losing? No, I'm operating good risk management based on the trade I'm doing. Of course, I fear the market. You should fear the market. I do believe that's the one fear you should have, or respect it more. It's not necessarily fear. You should respect the market. So I respect the market. If the market tells me that it goes down to here, then I've been wrong, and I want to be out of that trade because there's a higher likelihood it's going to go down here. You should just not put your stop loss. If your stop loss is in an obvious area, then either that trade is wrong or your stop loss is wrong. And then, so let's say that my stop loss is here and I'm doing this trade, and I say, well, that's a super obvious area for a stop to be. Either move it up or move it down. So I move it down, and then my risk reward changes. So now my risk reward is 1.72 on this move because I'm looking for maybe 10%. Maybe I'm at the middle of this here. Now that might work. This would be an okay trade, I think, on a longer term trade. If you're a breakout trader and you see this bar and you catch it in this bar and you catch it as a breakout and you say, well, I'm in this for not 16% beyond this channel. I'm looking for a longer term trade, maybe 40 or 50%. And then your trade style backs this up. Your trade style is that I look for breakouts. Maybe this is your rule. So it goes back to rules. My trade style is it's got to be above moving averages, and then I need to see a clear break. So you saw a clear break. Above moving averages, I got to see a clear break, and I buy the break, and then I buy with a 10% stop loss. And that 10% needs to be well below, right? This would be another way to make the rule. The 10% needs to be well below a actual support area, a heavy consolidation area, right? So this is consolidation. And ideally, this is breaking a value channel, which it did, and it's at or below one of the key value channel lines. So that would be another rule that you could set depending on your trading style. So if you do longer swings and you're more of a breakout type trader, this is a prime example of a breakout because it's above a moving average. It's trading above a moving average. And the second that it does go below these moving averages here, you need to rethink your trade. If you were in this trade now, you would be looking at this hard right now and say, well, it's no longer above moving averages. It's already past this one here, which is the 30 on the 1 hour. That doesn't necessarily mean anything. The other thing you'd be looking at is the daily, obviously. So you'd be looking at the daily. And the daily did finally pass this moving average here, and it's trading above all moving averages on the daily. But you also have to look at this on the daily and say, well, that's a big day. There's a 12% move, and if not more, before it hits some of these moving averages. But it doesn't seem to quite respect moving averages as much. It does kind of once it trades above it, but it's once again, I'm getting more deeper into trading stuff here. The key is, whatever you're trading, you need to ask yourself a couple questions. Number one, at what point will I be wrong about this trade? And I want to be out of that trade. The sooner the better. Number two, what type of stop? Is it going to be a disciplined stop, or I'm going to use a system and don't move it unless the market tells you otherwise? Obviously, the market's updated, you update your stops, you update your profits, everything else. The other thing is, do not put your stops in the most obvious places. Where does the market want you to put your stops? Don't put them there because you're going to get stopped out. The other thing I'd add as well is that consider, instead of entering where you're entering, would it make more sense in this trade to be patient and enter where my stop is? In a volatile market, when things are trending down or there's uncertainty in Bitcoin or the alt market, sometimes it's just very smart to enter where your stops are. Those are some of my best trades, is when I enter where my stops are, where my stops would be. So I'd look at a chart like this. If we go to the 4 hour here, it would be more like here. I'd enter on this retracement here. Let me scroll in here. So I'd enter on this retracement here, and I would maybe enter here, and then I would say my stop should be 5%. And then I'd look at that and I'd go, you know, it did break support here, but Bitcoin's weak, and there's other support here, and there's another channel here. No, I'm just going to be patient. And that's literally what I would do, and I'd be patient. And then it would have took me, so I'd put my stop down, I'd put my entry down here, right? That's saving 7%, but then in that time, that would have been 1 day. I'd have to wait, and maybe then I'd look at this retracement and say, well, it broke here. It finally did break there. All right. And then maybe I would look at this and say, okay, this is most likely will bounce here. It looks like it will bounce. It's at the top of a channel. I do expect some rejection. And then I enter a trade. I'd be wrong to the tune of 5%. And it would have been here. Let's say that I entered on this. I let it get rejected, and I entered here. Typically how I enter. I'm not going to, if I can catch it at the bottom, I do. But typically I wait to see some support kick in. And this is the 4 hour. And then I'd get stopped out here. And then I might look at the chart again and say, I'm going to enter here with 5%. If I got stopped out like that, I would typically take a break and say, you know what? I just need to, Bitcoin's doing something. I don't have confidence. And I'd either be patient, or if I saw something in the chart, I would enter. But then here, I'd say, okay, well, I'm going to enter this trade. And then maybe I'd be patient and say, you know what? I'm going to enter where my stop loss is. Usually if I get stopped out 2 times in a row or something, I get even more cautious. And then I'd enter down here. And then eventually I wouldn't get stopped out. I'd still be in this trade. This is for my entries on retracements. I do something like that. That's the type of thinking that I go through. And obviously I'm looking at all the other fundamentals. It's so easy to go back and obviously say this, but I do this time and time again. These are the type of things that I do time and time again in my trading, is I do this exact type of analysis, assessment, and a lot of times I am just entering where my stop loss is. And you will miss trades. So you might say, you might be here and just say, man, there is tons of weakness in BTC, right? Just tons of weakness. And it's going to break this channel. I think it's going to break the bottom of this channel. So here's my 5% stop loss. So I'm going to enter right here, and I'm going to probably catch a tail of a rejection here. But that's going to be my best entry. And then so you put an entry there with anticipation, and it never reaches there, and you miss that trade. Well, there's nothing saying that, okay, well, great, I missed the trade, and then maybe you see you see something that maybe some supply drying up or something like that, and you say, you know what, great. Well, you know, I'll enter here. You need to be flexible in your trading style, and you're going to enter here below the value channel, well below it. 5% is well below your value channel. You might even say, for this, I'm going to extend it out to like 6, because it did test this and it got some good rejection, and I'm going to give it an opportunity to retest the bottom and even maybe tail down a little bit, but then have some heavy rejection and support kick in and then kick it up. So I'm going to give it a little bit more room, 6%. So you might extend it to 6%. And I do that. So this is an exact example of how I would be looking at this, okay? I have a 5% rule, but at the same time, I say, at what point would I be wrong about this trade? And I also look at this and I say, well, this is such an obvious level for a stop loss just below this. Well, I want to be below that. I want to give it plenty of room, but not too much room where if I'm wrong, I have a larger loss than the potential gain or what I'm willing to actually look at for this trade. Now, obviously, this would have been a good trade here, 33%. But you had a lot of downside to contend with here too, right? You had a lot of chop here. So this is an example of, I'm simplifying all my analysis. I'm simplifying the value channel. I'm simplifying looking at moving averages. I'm simplifying looking at the waves. So we haven't even talked about this wave down, this wave up, this wave down, this wave up. We haven't talked about that, even though that this isn't drawn correctly. We haven't talked about the wave. So I didn't talk about what wave it's on or anything else, or how I look at waves. So I'm simplifying this concept for stop losses, but all those other factors about the analysis of a trade go into that. But I might move my 5% down to 6% just because, yeah, this looks like a good trade. It has a couple things aligned that I like to see, but 5% is the obvious place for a stop loss. 6% is not. 7% is not. And that's a good risk reward ratio, especially if you think that Bitcoin's going to do what it did here, which is kind of trade sideways and then make a little bit moves to the upside. Well, that gave the alts opportunity to breathe a little bit and to start making some gains. The key in all this stuff is that what I've shared with you is a lot of my trading style. You should have these rules written down and you should define these. And I believe that the tighter your stops, the less experience you have, the tighter your stops should be until you get good experience. And if you consistently, because it's an easy check, because if you're consistently getting stopped out, it's going to be frustrating, right? But you're getting stopped out because you're entering at a bad location, right? So you need to improve your entries. The other thing is that one of the things that is frustrating with this style with using a system, okay, is that Bitcoin will do this. We'll do this type of move. Where's my arrow? We'll do this type of move. And that you could have what you would consider a good entry on a typical non-volatile Bitcoin day, and it might hold up, but then Bitcoin will move and you'll get stopped out. And that sucks. And the alternative to that is worse, because the alternative to that is you do the same entry, but then you put your stop loss lower and you lose more. That's not good. So then what do? Well, you enter at the same place, but then you put your stop loss well below the standard deviation that happens on a retracement. You can do that. Why would you enter there then? I think that those trades are less than 50-50. At a minimum, you want 50-50, at a minimum, because all trades are 50-50, but there's certain things you can do that when you look at the trade and you say, well, Bitcoin declines and it goes down, when Bitcoin goes down, how far does it retrace? And you can just look at this and say, well, it typically retraces back 20% within a day. So if Bitcoin goes down, did it go 20% down here? It went 16. So you could enter the trade here and say that I'm going to put a 15% stop loss. That works. It depends on the type of trade you're doing. If you're doing a short swing where you're only looking for 15%, you're saying, okay, well, I'm looking to make the spread between here and this value channel. It's not a good risk reward. So you need to develop a system where either you're stopped out quicker or your signals are wrong, or you enter lower and you reduce that stop loss. So that's the only answer with the volatility of BTC. The other thing we'll talk about in another video is position sizing. You can manage some of the risk with position sizing as well, but that's beyond the scope of just setting stop losses. And let me just finish on some just very clear point of clarity, okay? I believe most should stop with a 5% stop loss. Start with that, and then if you're getting stopped out, you're entering too early, even with the volatility BTC, okay? Develop a system that puts you within that tolerance. The other thing is that the question that you should answer is, at what point will I be wrong about this trade? At what point, when you enter a trade, will you absolutely know that the trade is not going in your favor? That's where you put your stop loss, okay? And then I do believe if you don't have a discipline or you haven't developed it, you should use a system and not move it. You've done your analysis. And then what you should do is actually, when you reanalyze your position, analyze it as if you were entering that position at that point in time, and then make an analysis from there. And that's really the key. That's the key to setting stop losses. these should be an integral part of your system. You should develop these as part of your system, and they should be embedded into your system, and you should adjust accordingly. Adjust as your trading style changes, the different trades that you do, adjust based on the market. So you do have to, as the market moves more bullish, you need to be able to recognize more bullish moves. And you need to be able to understand that on bullish moves, support sometimes holds up better than, oh, it completely holds up better actually on bullish moves than on bearish moves. So in a bull market, support holds up. In a bear market, support does not. So that's kind of a good rule of thumb. So generally on a bullish sentiment of the market, support will hold up more often than it doesn't. But in a bearish market, support breaks down. Support and resistance breaks down. And it's just the way it is, right? So you have to be able to also understand and read the chart and read the market. And maybe when things are bullish, you do adjust your stop loss procedures. But that's something that I believe that if most stick to a rule at first until you get more experience, you'll be better off. Meaning that if you stick to a 5% rule or a 7% rule and you design a system around that, and your gains are 12 to 40%, you could just need to do the math, right? It's a pretty simple math. If you're losing 5%, but you're making 7 to 40, the math should work out unless you have a lot of losing trades. And if you have a lot of losing trades, then it's very clear what the problem is. Your entries are wrong. If you have a lot of losing trades, you're entering your positions wrong. And you have to start analyzing what you did wrong, where you enter the trade, what you can do better, right? Those type of things in order to then fix that and be within that tolerance. All right, that's all for this video. I look forward to seeing you in the next one.